Everyone's celebrating record highs in the stock market, real estate, crypto, and gold. But beneath the excitement, something feels off. Prices are climbing faster than incomes, investors are overconfident, and even the Federal Reserve admits valuations look stretched. Some call it the everything bubble, a moment where nearly every asset is inflated at once. History tells us that what goes up doesn't stay up forever. So the question isn't if this bubble pops, it's what pops it first. To understand today's market, you have to look back. The early 2000s had the dot-com boom, when internet companies with no profits traded like they were gold mines. In 2008, housing collapsed under the weight of easy credit and bad debt. Each time, the story was the same: too much money chasing too few real opportunities. What's different now is that this time everything is inflated at once. Stocks, homes, crypto, and commodities are all near record highs. That combination has never happened before in modern U.S. history. Let's put the numbers in perspective. In 2019, the S&P 500 hovered around 3,200 points. By the end of 2025, it trades above 6,700, an increase of more than 110%. The median U.S. home sold for about $320,000 in 2019. Today, that same home is roughly $410,000, up nearly 30%. Mortgage rates, however, rose from about 4% to around 6%, which means that monthly payments for the same home have nearly doubled. Bitcoin exploded from roughly $4,000 in 2019 to over $100,000 today, a gain of more than 2,000%. And gold, once around $1,300 an ounce, now sits above $4,000 for the first time ever. In short, stocks up 110%, housing up 28%, gold up 200%, and crypto up 2,500%. Yet the median household income? Up only 22%, from about $68,000 to $83,000. That's the imbalance fueling today's anxiety. Most people think bubbles form because prices rise faster than incomes. But that's only part of it. Asset prices rise when people believe they must rise. When optimism replaces analysis. When investors start fearing missing out more than losing money. The result is a self-reinforcing cycle. Prices rise, confidence grows, and people convince themselves that this time is different. But markets are cyclical, and just like gravity, fundamentals eventually pull everything back to earth. This time, the story has an extra twist. Technology and money policy are colliding. Trillions of dollars are flowing into artificial intelligence, creating its own mini-bubble inside the bigger one. AI is driving innovation, but it's also eliminating jobs and disrupting industries faster than the economy can adjust. At the same time, the Federal Reserve has pivoted from raising rates to cutting them again to support a slowing job market. Lower rates make borrowing cheaper, encouraging people and businesses to take on even more debt and push asset prices higher. Historically, rate cuts are supposed to prevent crashes. But when markets are already inflated, they often make bubbles worse. That's where we are now. A mix of speculative optimism, cheap money, and transformative technology, all reinforcing one another. It's a dangerous mix that history has seen before, but never all at once. The Federal Reserve has two main goals: keep inflation stable and maintain a healthy job market. But both goals are now in conflict. Inflation remains above target, yet the job market is showing signs of slowing. Traditionally, when jobs weaken, the Fed cuts rates to stimulate the economy. But those same cuts can inflate asset prices even more. If mortgage rates dropped back to 4% tomorrow, housing demand would surge and prices would likely spike again. The same goes for stocks and crypto. Cheap money chases returns, and investors flood in. That's the paradox. The very medicine meant to help the economy might be what makes the bubble bigger. And the longer this goes on, the more fragile the system becomes. So what eventually breaks a bubble? It's not always the same cause. In 2000, it was rising interest rates hitting overvalued tech stocks. In 2008, it was bad debt and collapsing mortgages. Today, the risk could come from several directions. One trigger could be a sharp slowdown in employment as AI reshapes the labor market. Another could be inflation flaring up again just as the Fed tries to loosen policy. Or it could simply be investor psychology, the moment people stop believing prices can only go up. Remember, an asset is worth only what someone else is willing to pay for it. Once buyers hesitate, sellers panic. And when that shift happens, no policy tool or interest rate cut can stop it. Since the early 1900s, the United States has faced 16 recessions and more than 25 market crashes. Each one felt catastrophic in the moment, but each reset the system. The dot-com crash wiped out unprofitable tech startups. The 2008 crisis cleared out bad mortgages. These events were painful but necessary. They forced the market to recalibrate. If today's everything bubble bursts, it won't be the end of the financial world, but it could be a long reset. Investors who are prepared, those holding cash, diversifying smartly and avoiding hype, will find opportunity amid the chaos. Because as history shows, recessions often create more millionaires than booms do. The signs are flashing everywhere: rising valuations, soaring debt, and a Federal Reserve stuck in a no-win position. The question is not whether the bubble exists, but how long it can last. Thanks for watching. If you found this helpful, hit subscribe, share this video, and leave a comment with your thoughts.